All right. So welcome to the recorded presentation on revaluation. This is our sample problem. Okay, so in our sample problem, we have ABC Limited, which acquired a machine worth $200,000 with estimated useful life of 5 years. Okay, so that was 1st January 20x1 with no residual value. So the depreciation is spread evenly through the years. ABC Limited uses fair value model on its machine. And then on 31st December 20x2, the machine has a fair value of $150,000 and with the remaining life of 3 years. And then on 31st December 20x3, the machine has the fair value of $80,000 and with the remaining life of 2 years. So we are required to journalize the relevant transaction on from 1st January 20x1 to 31st December 20x3. And then we have been asked to calculate the depreciation charge for year 20x4. All right, so the first journal entry, of course, we have to record the acquisition of machine, so debit machine and then credit cash. That will be on 1st January 20x1, $200,000. Then on the same year, 31st December, we have depreciation expense and then credit accumulated depreciation, 40,000. So that's obvious. We have $200,000 and we have to be divided by 5 years. So we have 40,000. For the next year, 31st December, same, almost the same. We didn't change the journal entry except for the date. So that will be 40,000. Now, we have been given with the fair value, okay, of the machine, okay, as at 31st December 20x2, that is $150,000. So before we revalue, you have to eliminate the accumulated depreciation first. So we will assume in this problem that we are using net method. In net method, you have to remove first accumulated depreciation and charge it against the property, plant, and equipment, and then you do revaluation. Okay, so already have 2 years depreciation. So 40,000 plus $40,000. So we have 80,000. So that's the amount that we reverse. So at this point, the machine recorded value after the elimination of accumulated depreciation will be $120,000. Okay, so in our machine, we have a gain on revaluation, 30,000. We have the fair value of the machine, 150, and then less the adjusted carrying amount of machine, that will be 120,000. So 150 less 120, we have 30,000. And then because this is year end, we have to reverse, oh sorry, we have to close the gain on revaluation against revaluation surplus. Take note, this gain on revaluation, if it is an initial increase on gain or increase revaluation, that will be charged to OCI. Then afterwards, we have to reflect the tax effect of the gain on revaluation. So to get that, we have uh, 30,000 multiplied by 30%. We'll just assume that it's 30%. And then afterwards, we have to close the income tax expense to revaluation surplus. That will be still under equity. Okay, the following year, we have given another fair value, which is 80,000. So, but before that, we have to recognize first, because this is a year end, we have to recognize depreciation expense first. So we have depreciation expense machine and then accumulated depreciation machine. Take note, we will use the new value, which is the fair value. Uh, from last year's revaluation, we have 150. Okay, and then remaining life 3 years. So we have 50,000. And then before you adjust for the new value, which is 80,000, you have to eliminate first accumulated depreciation. So we only have to eliminate 50,000. So some will ask what happened to the previous depreciation. Remember on 20x2, we already had eliminated that. So we only eliminated the new depreciation expenses or the accumulated depreciation we have, okay, after the revaluation. Okay, so in this case, 50,000. So debit accumulated depreciation machine and then credit machine 50,000. Now, before moving on to the next slide, we have 150 less 50. We have our adjusted carrying amount of machine, $100,000. Okay. And then we had been given the fair value. You can always refer to the previous slides. The fair value as at 20x3, 31st December, that will be 80,000. Okay, so after the elimination of the accumulated depreciation, we are now doing the revaluation. So in this case, you can see fair value, $80,000, and then carrying amount, we have 150 less 50, we have 100. So decrement will be 20,000. So debit loss on revaluation, credit machine. Now you can see in my note, normally this loss on revaluation, especially if it is the initial time that you reduce the value of the asset, it should be under PL or profit or loss. Okay, but the issue here is that we already had recognized a gain 30,000. So previously we have that. So we'll still charge it under OCI until we consume that 30,000. So in this case, for example, if in calculation here, fair value becomes, shall we say, 60,000 instead of 80,000. Okay. So so meaning that the decrement here will be 40,000. So what we will do, we will debit loss on revaluation OCI 40,000 sorry, 30,000 first. So we have to consume that under OCI. And then there will be another loss and revaluation here, but that will be under PL. Okay, so just to give you an example. Now, so we have already here OCI, loss on revaluation under OCI. After that, we have to recognize the tax effect. Okay, so in tax effect, it will be like this. We are just reversing the previously recognized gain on revaluation. Of course, not all, only portion of it because it's only 20,000, not 30,000. So debit revaluation surplus, we have 14,000. Deferred tax liability, again, assuming that the tax rate is 30%. And then loss on revaluation, 20,000. Okay, under OCI. Now, if it is under PL, no need to do this entry because it will be automatically closed on the normal closing procedure. Now, to answer the last question, okay, how much will be the depreciation charge for the year 20x4? Okay, so we have adjusted cost of 80,000 divided by estimated useful life of 2 years. So we have annual depreciation charge 40,000. All right, so thank you for your time watching the recorded tutorial session. Hope you have learned something.